Hello, Culture Matters podcast. Boy, I'm excited to introduce you to our guest. Before I do that, here's a quote just for this episode. Recognize that if it's humanly possible, you can do it too. Marcus Aurelius, our guest today, a great friend, is rejoining us for the Culture Matters podcast. If you haven't listened to episode 76, season 7, my friend today has been supporting our show for years. He's been a supporter of Culture Matters from the very beginning, before many of you likely even heard of what we were up to. They've, in a few short years in business, really acquired and grown a business of businesses, in a sense, in the acquisition and the sale business, or industry of business. We're going to talk about M&A today. We're going to talk about Main Street today, the everyday American that wants to buy or sell their business. We'll talk about life. My good friend Steve Sigman is back, and I'm so glad to see you, my friend, and welcome your new child into your family, and have this conversation today.
Well, thank you so much, Jay. It's always a pleasure to talk to you. And hello, everybody. Happy to be back. Hopefully, this show is not this one alone, but Jay's show in general is something that can lead you to a little bit more success in your business careers.
Talking about success, I know that since you were last on, for our audience, so they can follow you, just continue to grow and succeed and do things at a higher level. And I believe it was 2023, one of the biggest opportunities, deals, basically customer service involved, obviously helping a family or helping a business. You had a huge year, a huge what transaction would you call it?
Yeah, yeah. We closed it. We closed a transport logistic type business, and that was for $6.4 million. Sold it to that was an acquisition by a industry company that was expanding.
When you were facing an opportunity that was greater than you had yet faced, right? For our audience listening to this, you'd faced an opportunity that was greater than what you'd yet faced. Were you scared?
No, I don't think so. I think our training and our education, self-education, years of preparation, experience, really kind of just calms it. It's always a little stressful, especially in the last month or so, and when tensions get high and there's a lot of money about to be spent, and people are still spending money on attorneys and such. But I think the key is to just have the confidence that you've done it before. It doesn't matter if it's $200,000 or 10 million. It's the same process. On this particular one, and this is why we never talk names, because we can talk what happened a little bit more if we don't share any business names
Absolutely, yeah.
without upsetting
Please don't,
anybody.
yeah.
The eventual buyers. It took about a year from the first introduction to the seller to deal closed. Now that's not typical, but the eventual buyers came in awful low to start. So and this is where you see I clearly wasn't scared. We basically blew them off for 2 months until they came up with an LOI that just sending them quarterly financials,
Wow.
updated, and an updated CIM, and then when we finally received an LOI that we felt was within reason, within some percentage of what the seller would take, we then re-engaged quickly and got a letter of intent hammered out, which should have been pretty much the end of it, except obviously when we go to write the actual purchase agreement and such, things that were already agreed upon in the letter of intent tend to try to sneak back in there. So and that happened numerous times, and Unfortunately, I don't believe their attorneys were extremely versed. I think they bought mostly real estate in the past. I don't think they were extremely versed in solely business transactions, and it caused a little bit of confusion. But fortunately for my client and for the buyers, because of our experience in this industry, we've also worked with a number of great attorneys. And my seller was, I don't know, trusting enough of me, I guess is the word, or of us, to go ahead and use an attorney that we had suggested, because he did not like the feel that he got from his on the experience in this type of transaction. And I think without him, it would have been very difficult. He's very good too. His name's Kevin Brunick. He's retiring, so this isn't really a plug, but he's out of Virginia Beach. He's a great guy. Excuse me. And he's helped us close most of our larger deals.
What's the value in having quality legal counsel?
So, for the buyers or sellers of businesses, there's a number of attorney styles and things, but we try to find the counsel that knows the law, is protective of their client, but is not doesn't try to protect them out of making any money. So we call it a deal-friendly attorney. They understand that there's a company that needs to be sold, and there's somebody that wants to buy it, somebody that wants to sell it, and they don't get in the way. A good attorneys typically don't negotiate price or things like that. They may negotiate some legal terminology that goes in there. That should be handled. Especially if you're using a good broker, it will be handled, and they'll probably have more experience doing it and more ability to do it properly for you, because they can refer to the valuations
What are the
and comps that of other businesses being sold. Now, we're an attorney, we probably wouldn't have access to that information.
What'd you say? Sorry.
An attorney wouldn't necessarily know where to find or have access to some of that information of what the comps may be, and what the current market values are. If you talk to accountants, you get 5 different answers on what your company's worth. If you talk to a number of brokers, you're probably going to get a very similar one from all the good ones.
Oh, why is that?
Well, just like real estate, you guys, the real estate agents, and I know a lot of your clients, a lot of your watchers are real estate people. Real estate agents, they work together. They understand that this is the price per square right now. This is what people are willing to pay. So it's much easier to establish value. Whereas brokers, it's the same way. They look up sold comps to come up with that. We look up sold comps. We go through and make sure we have what's called the SDEs, discretionary earnings, or EBITDA, depending on the size of the company. We make sure we get those numbers right. We make sure we talk to the banks and see if when the books are good enough. Some of the Main Street businesses are not SBA eligible, but the majority of the ones we deal in are. And we make sure we get with them before we establish a listing price or sales price, that they would be willing to finance that number to the right buyer. That's another indicator that gets us something else we can explain to the buyers that proves the value of the business. Obviously, banks don't like to lose money, so they don't finance things if they don't think it's worth it.
So for the listener that's unclear on that, the small business is administration?
Yes. And these are SBA preferred lenders that we use. The SBA really is just a security blanket, basically, for a bunch of banks to lend for business.
So these are preferred
Kind of like the
lenders.
FDIC on our personal 250 grand in an account or whatever.
Yes. Okay.
So the SBA is now, and that may go back. At one time, they guaranteed 75% to these banks as long as they followed their criteria. Now they're guaranteeing 90. During COVID, they bumped that up
To what?
to guarantee 90% of the amount. In other words, if the loan goes bad to the bank and they follow the SBA criteria, the bank gets their money from the SBA, I guess, immediately. I'm not a banker, so
Wow.
I don't know exactly how quickly it happens, but they would get their money from them. And that way, so at 75%, if a lot of businesses are goodwill heavy in price. In other words, no tangible asset to be resold by the bank if something goes wrong. So After the bank sells the tangible assets, when it's 75%, they may not get all their money back. They're also requiring a little bit higher down payments at that time because of the fact that the federal government wasn't earning as much money. Because we all know banks aren't going to lose money.
What are some of the reasons why our business owners listening have their businesses can become such goodwill heavy? Like, what's goodwill?
Well, I was like, okay, so goodwill is the portion of the valuation of business that cannot be determined in a physical asset. Sometimes you can break that down into different categories depending on people. They might say your website, your goodwill, but things that aren't necessarily physical assets that have been depreciated or listed as trucks, computers, things like that. Yeah, those are assets. So, a lot of business, like my business, the physical assets, like I said, I wouldn't include my collector's truck as part of the sale. The physical assets in my business would be just thousands of dollars. Whereas, the goodwill and the reputation, the marketing that you've established, those kind of things, that's what oftentimes is a large percentage of business.
Would it fit under if I have client relationships that that could be capitalized upon or upsold?
Correct. So, say your company is let's say they're a heating and air company, because they're going to be a little bit heavier on the assets and goodwill, but not much. You got 5 vans out there, they're running around, but you've got a couple really good, solid, either government or commercial contracts like that with people. Now, that's not how the business is valued. You sell the business as a business typically. Contracts can't be sold, of course, but typically sell the business as a business. But a good portion of the reason that business has the earnings that it does and gets to the valuation it does is because of those contracts, relationships, so forth that they have. So, when a business transaction happens, if there's a lot of relationship value there, typically the seller sticks around for a good while, depending on how much of it and how detailed, and kind of passes the baton to make sure that, that the people are going to be happy with the new person. They don't always tell them it's sold right away. If there's a crucial client that they would like to get to know better, I mean, that's not necessarily what I advise.
Sure.
I advise, in your contract, if there's a contract with somebody else, that you have that assigned or get a new one before you close. Of similar matter, that's just the safest, cleanest way to go about it. That way there's no question down the road of what was done properly or not.
I wrote this down. I want your insights on this.
Sure.
Relationship. So the relationship value has an impact on a higher or lower multiple depending on the actual physical.
Right. So the earnings have a multiple. Now, the majority of that is obviously created by relationship. We're talking how we allocate the sales price and what determine what's tangible and what's intangible in the total value of the business. So just for instance, say that HVAC company made $300,000 to the owner. It would be probably worth in the range of, assuming that owner was not out there turning wrenches, assuming he was managing that business, it would probably be in the range of, $750,000 to $900,000 business. Now, of that, he's got 5 vans that are 2 to 5 years old that cost $60,000, to equip to start. So he's got $150,000 and, maybe some other tools, maybe $200,000 in tangible assets. So as you see, that number gets much larger. And that's why the need for the SBA, because in most business deals, the bank can't take a lien on enough assets to cover much of a chunk. Because think of it, if we're saying market values, $250,000 in assets, the bank's not going to get 100 by the time it's all done.
So this makes me,
because they're going to send that to auction. They're going to pay an auctioneer. They're going to take less than you would if you were selling it, over a couple months or whatever. that bank's, they're not really even looking at the assets in most businesses. They're looking at the cash flow and the worthiness of the borrower, at least in business credential, to understand how to run that business. And then look at the history of the business, obviously.
So the bank doesn't want to keep that business on their books if it's not performing.
Well, it's not really on the bank's book. All the bank cares is that the note's being paid back. It's like a
Got it.
home loan, right? So the bank is not owning the business. Of course, they have a lien on it. The individual is owning and running the business. The bank, the SBA, the lender, obviously, is just, they're lending the money. What they don't want to do is go in and sell brewery equipment or vans, or tinting machines or milling machines or things like that, because it's not their business. And they set up option companies to do it. Like I said, they get pennies on the dollar for market value.
Are there people that go in and partner and buy distressed assets and fix them?
Sure. I get emails all the time. We're not in a very manufacturing heavy area here in Virginia. But a lot of manufacturing facilities, if they're struggling, certainly there's people that would come in and buy them all. And then, they distribute it out, sell one machine here, one machine there for a profit. Those are things you can get loans on your assets too. Obviously, if you're struggling, you need to, but you think you can make it through it. But those are typically heavier asset things. There are people that buy distressed businesses. We don't deal in too much of that because the valuation is very difficult. And I like to be very clear with my clients, what they should expect to get when we start the process, not later. So some brokers will, they'll go into someone's business, and they probably know it, maybe worth $1 million too, but they want 2 million and they'll list it for that. You're not going to find us doing that because I'm here to actually get the job done and sell the business, not to list it. Obviously their hopes are that, they get a few offers in and the owners will come to realization, which is nothing wrong because it's still an attempt to get the job done for them, what they want. But I think it's much more ethical and much more preferred by the sellers if someone comes in there and tells them the straight truth, what they should expect. That way they can do some planning.
I got a
They
question
might have
for
given the
you.
last 30, 40 years to their community. They kind of deserve the right to know, at least within reason, what they're going to be able to sell their business for before they put it on the market.
That makes sense. When I'm learning about this difference between hard assets,
It's a taxable difference too.
the tangible versus the intangible. When I think of intangible, now I'm thinking, you said goodwill, you said relationships, it has this connection with revenues. So I'm thinking that's culture.
Yep. Yeah. That's the culture of the business. That's right.
It's very
And it's typically the
profound.
greater value of the two.
Say that again.
It's typically the greater value of the two, as far as tangible assets or intangible assets, or what you like to see, the culture of the business is actually a good way to put it.
Yeah, I haven't quite
With
thought of it.
I look at the culture, the processes that the founder, the previous or the current owner put in place. The kind of atmosphere he creates in his facility, which leads to productivity or non-productivity.
And that affects
Leads to
both of us.
quality of work, all those things. So when you find a good company, obviously that person's been doing something right, more than just going out and getting jobs or getting revenue. They've been servicing that revenue properly, servicing their employees properly, so that they stay. Because good companies don't exist without long-term employees. These people can be replaceable, and you should never treat any employee like they're not. I don't think. At the same time, you need to treat them like they're the whole reason you're there. Because without them, unless you run a one-man show, you don't have a business. Now, maybe in a restaurant, you replace servers often. In a small service company, you'd probably like to have very, very little.
Why?
Well, I mean, first of all, you're going to have processes and procedures and opinions of how things should be handled that may vary from other owners. So even if you're hiring experienced people from other companies, they may not be set up in their mind, and it just may not be ready to mix into your culture and the way you do things. I typically do not hire people with experience in my industry because they may have already learned bad habits, and it's harder to untrain bad habits than it is to train someone from scratch that's a open slate and willing.
Hmm.
So I just look for intelligent people. Obviously, there's a certain amount of intelligence you have to do the financial part and to understand, how to talk to different types of individuals. But more importantly to me is that we do everything the same and with the same integrity every time. And that's something that's much easier to teach somebody that doesn't know what should be done or not. And then obviously you want to hire someone that you feel has a moral compass, because there's a lot of gray areas in an industry like ours or yours, consulting, real estate, business brokerage, even regular brokerage, retirement planning, all those type of things. There's a lot of gray areas in what's right for the client and what's padding your pocket.
How do you navigate that personally?
Personally, I'm fortunate. My wife is wonderful and very intelligent, and has a very nice medical practice. So it's easy for me to not get the money on my eye. And we've done okay so far with Transworld, with Virginia Business Sales over the last 6 years now. Almost 6 years now that I've owned it. So that makes it a little bit easier with the guys that are just getting going. I think a lot of it's done in the interview process. I kind of let people know your 6 months, your year, possibly your first paycheck. It can be a very rewarding business, and you can make a lot of money, but it's going to take a lot of work. And you should know that you have some to support yourself and your family, or your wife has a job or whatever, until you get to that point. So I kind of try to really make sure I said, you're sure you're comfortable not getting a paycheck for 6 months to a year. Reiterate that. Obviously, I do what I can as far as covering their marketing needs and things like that until they start rolling. Just to make sure that, because anybody that I hire, we don't have many brokers in my office. I have 3 guys right now. Had a couple others over the years. These guys have all been with me over 2 years now. You might have only had it 6. I don't like to bring a guy on any more than every year or two, just because I feel like between myself and my right hand guy Carvin, he was with the company when I purchased it. He was there when I got hired before I purchased it.
Wow.
And between the two of us, I think we like to split training. He'll go to some listing meetings with him. I'll go to some listing meetings with him. He'll be involved in some negotiations. I will. And it takes time to get into that many things, because you don't have any listings when you first start. And you don't get any buyers until you have listings, basically. Any real estate agent kind of knows that. At least in the old days. I don't know how they do it now, but so it takes a little time to. I try to, if I have a listing that I believe somebody newer could start handling the buyer, when I feel they're ready, I'll start setting up some of the buyer leads. That way, they have an opportunity to make some money before they get their own listing in. Obviously, we do just like real estate agents do. When there's a queue in the office. But when they first come on, it takes some time to get those experiences for me to feel comfortable. And you can't manage but so much of that at once if you really want to do it right. And that's me. I also don't want to work my whole life away. I'm 50 years old now. I have two wonderful young boys, and if I was younger, I would probably hire 10 guys all at the same time and pick the best 6 and roll with it after 5 months or something. But at this point in my life, I think, and knowing that not Transworld Business Advisors or Virginia Business Sales LLCs or anything of that anymore, because we've been around a while here. It's Steve Sigman and James Farrow and Matt Morris and Carvin Chung. Those are the things that people trust.
Mm.
So, and the reason that is because, obviously we've tried to act in the same in manner throughout the years, ever since I took over and before. The previous owner was a great guy. So I think that's a big part of it. Anytime in business, if you look at what's best for my client at all times, and that may not always make them happy, because sometimes you got to tell them something they don't want to hear, because that may be the best option. But if you keep that in mind all the time, I don't think you have to worry about the money. Granted, business like this has a runway, but after that point, if you continue that and continue to do that, it kind of snowballs. And people that are appreciated, respected, not pushed, left to be in charge of the sale of their business, basically, just with our assistance.
Wow.
Is the best way to do it, because it's their business. They build it. They know what they need to get for it, what will make them feel happy when they leave. If that's not a number we can achieve right now, instead of listing, and they may list with somebody else, sometimes they do, but instead of listing them at that number, we'll go ahead and work with them or get them in touch with somebody that can work with them to get them to their goals. Sometimes they say, well, I'm just done, I'm tired. You tell us what it's worth. And this is a lot of what we get. Retiring people that just don't know. They've never really sold a business.
Wow.
They founded one and built it and run it, or their dad had it and they took it over and ran it. And now their kids, they got these fancy degrees and they don't want to run the AC business.
Wow.
Because they did very well for themselves. They sent their kids to good schools, and they want to do something that's a little bit easier. And the parents don't blame them, I don't think, in most cases. And it's time to sell. And they don't really know about that. So they, and of course they have a number in their head most often. But they typically, most businesses, we look for our guidance on what the valuation is, and then determine if now is the right time to sell based on it. We're not a pushy business. We get an offer in that's even if it's a very good one, we're not going to push it down their throat. We explain it to them, share it with them. If they want to pray on it, whatever they need to do. We get a lot of clients that say, I got to pray on this for a day or two. In Virginia, I guess it's a fairly conservative area for the most part, even though it's blue now. But, a lot of people here are, and I suppose everywhere. But, so we get a lot of that. But mostly it's people that are looking to retire. Those are also the best businesses to sell, because it's easy to explain to the buyer why they're selling.
Oh, like it.
When you get a younger guy, the buyer's like, well, why are you selling now?
Yeah, that's a good point. It makes sense.
Right. It makes a lot more sense to the buyer. You got someone, that's 40 years old, and they're selling a business that makes, $400,000. You're like, well, why? Well, first of all, think about it. He's been making $400,000 for the last 20 years. Maybe he's ready to retire at 40. Yeah, if he's not wasting it. If he makes that, maybe he wants to do something else. Maybe that's something he was doing as a teenager and it turned into a business, and now he just wants to do something completely different. But that's a little harder to explain sometimes to buyers. Get a little bit more worried that they're going to, come back into competition against them in some time or something like that. But all those concerns obviously can be handled in the way, non-competes and different things are written.
Yeah.
But, having that kind of willing to retire, SBA approved, some seller financing available, and then the appropriate price for the earnings, and documentation, good books to be able to prove those earnings. That's another thing. A lot of business owners, and we all do it. We take a lot of discretionary things in there. That can be used, but just document it well. My suggestion is, if you have a little bit larger company, maybe it's making $1 million a year or upwards to you discretionally. If you're going to plan on selling, and you have to look at this valuation to tax, implications, try to clean it up as much as possible. It doesn't mean don't buy your car in that business and depreciate it. It just means, maybe don't go to the coffee shop or the grocery store quite so many times if anybody does anything like that, with the company money. Meals and entertainment, just like taxes, people don't know for sure, was that needed or was that all personal?
I can't work without this coffee.
Yeah, well, and that's part of it. And the coffee thing, that adds up to so little. It's probably not going to matter if you're making a living. But that's just kind of an example. Like cell phones, a lot of times, when we get to bigger businesses, we're not adding that stuff back. So if you want to use that for a tax break to pay in your business, but don't think that's part of your, earnings.
Is the multiple based on the the net or
Based
something
on
else?
the net. Gross means very little to most people. Just like if we think about it a little bit, well, would you rather sell $500,000 worth of stuff and make four, or 10 million and make four? One seems a lot easier, doesn't it?
Yeah,
Business might be worth more if it's got a lower revenue and a higher return because the return rate is more.
because of
So
the
that way, if you
return
scale
on
it, you get a
cost,
quicker return on your investment.
because the return on the money is higher.
Yeah, right. Because your profit, margins are higher. Like in a business brokerage, we have marketing. My profit margins aren't 90% by any means. And after you pay out your commissions to your brokerage boards, but it's a high profit margin business.
And
Consulting, whereas like manufacturing tends to be a pretty low profit margin business. You're dealing with big numbers, a lot of expensive equipment, and that's why it's phased out of our country because there's so many easier businesses to run. There's a lot of capital and requirement for manufacturing, a lot of expensive equipment, and then there's a smaller profit margin.
what about the multiples? Is that how does
Well,
that
now because of the
factor?
high amount of capital that it's already purchased, of course, the multiples on a manufacturing business are going to be higher. So when it is time to resell, manufacturing may go 4, 5, 6 times. And we're all talking about businesses that make less than 10 to 20 million in profit. Things bigger than that, it's not our forte. Honestly, we haven't done one that has 5 million in profit yet. But I, from my understanding and talking to other guys that have, it's not that much different than the 4 and 5 and 6 million ones we do regular. And those are businesses that have, somewhere typically between a million and, 2 in their discretionary earnings number.
So that's possible for the everyday American to build a life like to that level. You see it every day.
Sure. I see, I see restaurateurs. And keep in mind, this is what you're selling the business from. Obviously, they've paid their salary and benefited from that business for years. So it's not like it's all that work for $2 million. It's just, and oftentimes what a business sale is it's the same thing as you go and turn at 72 and cashing in your 401k.
But you
Except
get
it's
the
not as
money.
taxable because you're going to tax on all the goodwill and such. All the intangible assets will be taxed at capital gains rate.
Really?
Yeah.
Which is a low.
Whereas if you pull money out of your 401k, as you pull it out, you're paying income tax based on the bracket of amount of money you pulled out and made that year. So the physical goods are based at straight kind of income tax. And this is in most businesses. So C Corps are a little bit different. But most people we deal with, and because of the tax penalties of a C Corps when selling it, and pretty much most people have LLCs and LLCs as S Corps. We do run into C Corps, but as you know, they get taxed and so does the owner. Those businesses, oftentimes, we can work a shared sale. So in other words, someone would buy 100% of the shares of the company, and the name would stay in place, and then then it's more like in the taxation situation of selling an LLC for the owner, maybe even a little bit better. With that is you can't redetermine the asset value in any way, because whatever the things have been depreciated to is what it is, because that corporation has already taken that depreciation. When you sell a business, you can negotiate. Oftentimes, and most times, a business owner's assets aren't going to be worth what it says on their balance sheet. because they're going to depreciate it quicker than it actually drops in value. So when a business is sold, if there's any significant money in assets, there's a negotiation that goes on as to what is the asset allocation. So it says on your balance sheet that you have $0 in physical assets, but we know it's worth 200,000, and you bought it for 5. So where do we put that? And then obviously the seller wants that to be as low as possible, and the buyer would like it to be as high as possible, because that's the number that they start their depreciation based on in their new business.
And that helps them.
Right. So the higher the asset value is, the more they can depreciate, for tax breaks over the future few years. Whereas with the seller, the lower that, asset value is. And there have been times that prices even changed because of that. It's still a benefit, to both. Not a benefit to both, obviously, but better than it could have been if we changed that asset value. Because the tax savings were less than the change, or more than the change in price.
Does this
tax penalty, on the other hand,
yeah,
was less than. Does that make sense?
do you find that business owners are overwhelmed without help?
A lot of times. Probably the most difficult problem. A lot of this stuff they understand and they'll get. I think they still need to be told, because I don't think there's a good place for information as to what the real value of the business is. There's been some studies that businesses sold with business brokers sell for 30% more than your average, than transactions, transacted privately, totally privately. No, granted, they have to pay commission on that 30. So they still net quite a bit. Obviously, we're not charging 30% commission. Yeah. So, and you have someone to walk you through the process. There's a couple reasons for that, and I think the biggest one is because most business owners are pretty intelligent. Look around, can figure things out. After talking to a number of buyers, getting a few offers, would be able to kind of narrow it down to what a fair price is. Maybe, because you never know who's coming along giving those offers. One of the things we do, obviously, is weed out the low ballers and the people that are going to make ridiculous offers that business owner doesn't need to take those risks, because we could find someone to get an SBA loan, or set up a different way. You get earn-out offers and small down payment offers with seller financing and things like that. The business is set that way, but it's a whole lot riskier. So when you have a broker that can bring numerous possibilities to you, we can find that person that's not, watch these videos, buy a business for $1 and trying to employ these things that are only work if somebody doesn't know.
Oh, can you unpack that a little bit? That's a good point.
Well, there's a lot of people who go out there and try to put 10% down and then say, after a couple of years, the business is going to be able. There's no reason to take those kind of risks. If you've built a good business, we can find you someone that's going to bring you most all cash, whether it be from them directly or from them in the bank. Typically, sellers do take a little bit of a note in any business transaction. Even with the SBA, they might take 10% to kind of a couple reasons for that too. One, obviously, offering that and being willing to do it gives the buyer faith that you're going to stick around and make sure it works. You still have skin in the game. That's why the bank likes it too.
Lowers the risk for the buyer because
he's got the owner has skin in the game. They have skin in the game, so they're not going to just walk away or not answer phone calls if they need help.
The intangibles too, that would affect that, right? If my intangibles are crap, I want to get the hell out of Dodge.
Right. Well, yeah, that's right. So yeah, obviously, if your relationships are bad, if you see a trend in the industry, it's going down fast. You wouldn't want to seller finance, right? You want your cash to get gone. Yeah.
Yeah.
So that's kind of a confidence builder.
There's a push pull on that. How much do we give? How much do we get?
Yeah.
If I'm the buyer, I want the seller to have skin in the game. If I'm the seller, I want the buyer to have skin in the game.
Yeah. Well, if you're the seller, you want all cash. Because that's what they all want. But most of them will listen to you and come to the realization that the way to get the most out of their business. And but keep in mind, I don't know of one deal that we ever closed with bank lending and seller financing that didn't get paid or isn't being paid.
Wow.
There are a couple, and it's unfortunate, and I think every brokerage has seen it. Obviously, we try to avoid it. Our track record is pretty good. It's only two that I'm aware of that were done as deals where like they put 50% down and the other 50% is seller finance because the books weren't kept well enough for the SBA or the profits just weren't big enough.
Let me get this
You know,
straight.
you have a small business, SBA lenders now, if business isn't worth 400 or 500,000, if it's not making a couple $100,000, they're not looking at it really.
So let me get this straight. The people that have been told, our listeners that have been told they can go out and buy businesses with nothing down, that might be possible, but it's probably because the seller doesn't know enough to really.
Right. Or that business is severely distressed.
That's a
Now,
great
a
insight.
good, solid businesses demand, bank lending or equity, money, depending on the size, and they get mostly cash. As it should be, just like when you sell your house. The key is keep your books good and such. I almost look at those guys, and hey, I'm all for entrepreneurialism, but I look at the programs, buy it for nothing. Now, if you want to say I can buy it for 10% down, and you have some other assets more than that 10% down, then you're being realistic because that's what a bank will do. Say you got a $3 million deal, you give them 300,000, the seller finances 3, the bank brings the rest. But you better not just have only 300,000 period ever, counting all your stuff. You got to have that cash, some other assets, that the bank can look at. Now SBA, isn't supposed to look at all that stuff. Good credit's important. No bankruptcies is almost absolute to get an SBA loan. But if you have those things going for you and have the 10% and, reasonable amount of assets, a little bit of retirement money, some equity in your home, the bank should look at that as long as you have experience in that field. So, you could buy 100,000, you save $100,000, you could very conceivably buy $1 million business. Something making you, $250,000, $400,000 a year, depending on the industry. That's attainable to a lot of people, right? To save up 100,000.
To save, so save
To be able to save up a down payment for a business, to save 100,000 by the time you're in your 40s or so, is attainable to a lot of people. Because keep in mind, you can use some of your retirement stuff potentially as part of that.
You can save that 100. You can go to the preferred lenders based on the SBA.
Mm-hmm.
And you can work with someone like yourself to find that business.
Yeah.
To then buy for $1 million, where the seller gets $1 million.
Yeah.
Or they get 900,000 with a 10% note.
Right. Yep. Typically,
you work that into the deal, and you then improve that business. You get it to a $5 million business over some time,
potentially,
and just maybe someday sell that yourself.
And some people, hey, if you've been working in corporate making 150 in benefits, you've saved up 100,000. Now you can buy a business that's going to benefit you 300,000. Granted, you'll have to use that business as your retirement plan or create your own. Yeah. You have to pay for your own health insurance or not. There are a bunch of companies out there that are let me call it partnerships, health partnerships, that are much less expensive for independent business owners and things like that.
Health insurance.
They don't necessarily have the best coverage, have big coverage on big things and none on small stuff. Kind of like an Aflac type of thing, but for illness as opposed to injury. Or you could get an expensive health plan if that's what you need. You're still netting more money. And in a business that, say, you make the same amount of money as your salary, if that's what the business bottom line is, that business owner is going to be in much better shape than the person living on the salary. There's just too many things, your car, too many expenses you could be running through your business. But even if you say it's still a cost, it's still coming out of, but it's a cost at less whatever tax you would pay that you're always paying every time when you get a salary W-2 check every month
Hmm.
on everything you do.
So in
If you're working, hey, I'm working, I might be an hour away from my house. I can have lunch. That's a write-up because I need to eat during that workday. If you work for a company on salary and you're out, you can't write off your lunches. You can't write off your miles. You can't write off or or buy your vehicle in your business and depreciate it. But a lot of reason you'll see people get into a small amount of rental real estate too. It allows them to have a business and somewhere where they can do some of that discretionary stuff. I always say real estate is it's not to create wealth, especially commercial, but it's to get tax breaks.
Hmm. Hmm.
If you ever bought commercial real estate, the first few years you're in it, typically the only benefit you're having is a write-off. And it depends on what level you enter, obviously, of course, and how much you can buy at once. But the normal person starting out buying a building or two here and there.
Hmm.
It's just it's expensive. You go on lease for so much, you're going to have empty time. You got debt, which is always changing. In investment, obviously, that's one nice thing about the unfortunate thing about the SBA. Obviously, it is a variable rate loan. Typically, it's prime plus 2 or 2.5 or something like that. Sometimes the banks are working on bigger deals. They might do 1 or 1.5 because the interest rates are high right now to make it eligible. But that's how it works. Obviously, commercial real estate, you get a fixed rate, but it's going to balloon it on you every 5 years.
Hmm.
So, because these are investment things, you got to put 20% down, which is more than a business, which is kind of wild, right?
Steve, I
Yeah.
really appreciate this master class today. How can people follow you and get in contact with you the most quickly if they're looking for your need, for what you do?
Well, probably my email. I can leave a link to my. I could send you a link to my website, which you can inquire from me or any of one of my teammates that you'd like to have a conversation with.
And what's your
Um,
email?
yeah. So the quickest email is steve.sigman@tworld.com. I could also be found at www.tworld.com/Charlottesville, Virginia Beach. Those are the places that a lot of our stuff. Mostly, our client list comes from word of mouth. We do get call-ins. Some people just say, "Hey, we're pretty good with SEO," even though I don't put a whole lot of weight into internet marketing for something of this type. But we do show up first in those cities that you, Charlottesville and Virginia Beach. If you search business broker, you're going to find us right away.
Hmm.
But we get some that way, but mostly we get a lot of it because we are local. There are a lot of brokerage firms out there that market these guys and stuff, and they're from wherever. They'll market just certain type of industry, maybe. Some people, like the fact that they've done that industry a lot. But typically, when it comes down to it, they prefer to work with someone they're going to see face to face. They know is local. Um, these guys aren't flying in for every facility tour and every meeting between a buyer and seller necessarily. We're always there. I find that important because when a buyer's coming in, some people will ask questions that it's not the right time for you. Be a little aggressive about it. It'll make sellers uncomfortable. Having a broker there, navigating that waters, and if you're a buyer too, because the last thing you want to do is upset the seller of a business that you'd really like to own one day.
Hmm.
Because as we know, something of that nature is very emotional. Selling your baby, selling your business, this thing, for most, anyways. Not all. Some people are very, analytical about it, and very planned, and they started this business, plan on selling it 10 years later. But for most, it's a very emotional decision. So, you want to be someone that, as a buyer, for your best chances, you want to be someone that follows the lead of the broker and the seller. No, that doesn't mean you have to pay what they tell you to. You should offer what you feel it's worth to you in every case. And if it's just not the same amount as that seller will take, then that's just not the right business yet. But you should follow it in procedure, and if they're comfortable talking about something now or later. In all these contracts we do, there's a due diligence period, just like a post offer inspection on a home or something like that. It's much more detailed than that, of course. That protects them if they get and find something they don't like. So there's no reason not to follow, the kind of the lead of what the seller's comfortable giving you now, and what they're comfortable giving you after they understand that you're willing to pay a price they're willing to take, and put some money in escrow. Obviously, we think that the buyer should get all the financial information and legal information, anything else, and the SBA is going to want it too, of course. Um, that the seller can provide. It's just there's a right time for that. A lot of people want to see a lot of stuff before they meet them, before they make an offer. And I would tell them that you can't buy a business on the books alone. So the most important thing is that you know the business, know the seller's philosophy, know how he's run that business, understand what he does on a daily basis. If that's something that you want to do, or you have somebody that can do that for you, before you even start thinking about the money part of it. Now, obviously, we're looking at businesses that say they make this much to this much. So that's kind of covered in there. It's going to make the amount, or theoretically, and, a good broker will be able to prove the numbers that they're advertising. But, you're looking at what should make the amount of money, range of money that you think is going to work for you.
Hmm.
But after that, you have to decide what business is right. And if you can work with that person, transition of a larger business, you might have to work with someone 3-4 months. If you don't get along with the seller, it's not going to work. You don't have to be best friends, but having a mutual respect and understanding. And most of the buyers we have, there are a few that think they know everything, but most of we have, their whole intention is to go there and change nothing. Learn as much as they can from the seller while he'll stay, and run it for a couple of years as close to how he has been doing it as possible before they start, adding their personality, their desires to it. Because that's a time of potential catastrophe when you have a transition. If things change dramatically, clients migrate somewhere else, and then you got the bank loan in this business and not the revenue. So in most cases, that's done. In most cases, employees don't go. Most business owners and people that buy them treat their people fairly, and the new person will come in, and they understand that the employees are just as much as an asset as the goodwill and the other things that are a large reason for it. And, they treat them as sometimes better, but they're going to come in and treat them with respect. And that's another reason we typically have some transition, because sellers can say, well, this guy, you need to do this. He's got a little bit of ego. So he's a great employee. So we have to say this. We talk to him this way. This guy, you could just tell him flat out what you need done, and he'll do it. He doesn't put emotion into work. He just comes to work. And as there are tons of personalities in any one given workplace. So I think things like that's part of the transition.
Hmm.
An important part, as we talked about from the beginning, kind of the employees are a big thing, and you get a lot of buyer. Well, how can we guarantee all the employees are going to stay? Well, you can't do that. We can guarantee they're not going to most likely leave before it's sold, and then it's solely on you to keep them. If someone pushes you, it's just like, well, don't be a jerk. We advise, obviously, to our clients. Most all of them are sellers, that you don't tell your employees anything about the sale until it actually is consummated and you kind of introduce the new owner. Reason being for this is not that employees are bad people, not that they want to run, but uncertainty is much scarier than, oh, the business was just sold and this is my new boss and my job's not changing. You know, and they haven't had time to think about going somewhere. So now it's today. They still got to get a paycheck. You know, whereas if they know months in advance of a sale, there could be, you know, they might have seen someone walk through that they really didn't like or something and think that's going to be the buyer, and it may not be at all. It may not even have anything to do with the sale business. And they might start looking for other jobs because they can go and say, well, I know who my boss is going to be over there. You know? So, and only because, not because the sellers are bad people or anything, just because there's uncertainty there as to what would be next. And the cases this happens with, obviously, is the key people. The people have come to know the owners, you know, be very comfortable around them. So, you know, typically I would suggest, you know, unless you feel like you have some obligation to not tell employees ahead of the game. It seems cold as a business owner that's, you know, have these people maybe working for you for 20 years and they feel like part of your family. But it's the right move for them and the business in the long
Hmm. Steve, thank you again for coming on this
run. Absolutely.
part two of a series, I believe, of
Oh, we've
how
gone
to
over. I'm
sell
sorry, Jay.
without. No, this is too valuable to skip. So I challenge all the listeners, please share this episode out. Please follow Steve and leave a review on the Culture Matters podcast. We greatly appreciate it. And we will see you next time on the Culture Matters podcast.
Thanks, everybody. Have a great day.